Hi, just a video on sales variances. So variance analysis is a topic that is quite commonly on paper 2 for A-level accounts, and sales variances, however, not as common. So it's good ones to review, ready for paper 2 in 2025. So we've got the sales variance. So the total sales variance is the difference between how much we actually sold and our budgeted sales revenue. We then have two sub-variances. So we have our sales volume. So that's looking at how much we anticipate to sell. So our budgeted sales in units. So we think volume is an amount of activity. And so did is the amount of units we actually sold. So we get a difference in units. So unlike the cost variances, obviously the higher the sales variance, the better. So a favorable variance will be a higher amount of units. And we got to multiply that by the standard or budgeted selling price per unit. So some of those figures you'd have to calculate within the question. If we have a sales price variance, just think about what the words are saying. Sales price, we're making a judgment on the price we sell our products for. So our should is looking at how much we should have made in revenue for our actual sales. So our budgeted or standard selling price per unit multiplied by our actual sales. So that's saying if we sold it for the price we thought, how much we think we would have made of revenue compared to what we actually received. Let's look at some numbers to reflect this. So we've got a business is forecasted to sell 10,000 units with a budgeted selling price of £24 per unit, but they actually sold 12,000 units for a total of £195,000. So if we're going to review that, put the variances here. So just go through them one by one. So if we do the total one first, and see if this highlighter actually shows. It's not a highlighter, so that's a good start. Let's try again. So the total one. So how much we should have sold? Well, we said in the budgeted we should have sold 10,000 units for £24 a unit, so we should have had revenue of 240,000. But as we've been told, we've actually got revenue of 195,000. So clearly we've got a variance of 45,000 adverse. If we're looking at the sales price variance, we're making a judgment as to whether we hit that £24 per unit we said in the budget. So if we did sell 12,000 units, or sorry, we did sell 12,000 units for £24, we should have received £288,000 worth of revenue, but we did receive 195,000. That clearly shows an adverse variance of £93,000. So we've obviously sold it for less than £24 per unit. So if we look at the sales volume, we said we were going to sell 10,000 units, but we did sell 12,000 units. So we should have sold 10,000. We did sell 12,000. Well, that's good. We've got a 2,000 favorable variance, but that's in units. So 2,000 units more than we thought. At that £24 selling price, that means we've got a 48,000 favorable variance. So we have sold £48,000 more at budgeted level, but we sold them for a lot less, which was 93,000 adverse. So if you combine those two, so the 93,000 adverse, take away the 48,000 favorable, gives you the total sales variance, which is £45,000 adverse. So if we were going to explain the interrelationship between these two, it looks like we've sold them for considerably cheaper. That's attracted more sales, but not as many as we thought. So actually price isn't as important to our consumers as we thought. So we haven't sold as many extra at that lower price as we would like. So overall, our revenue has fallen by £45,000. So we've got a £45,000 adverse variance. Okay, I hope that helps. What I would say is working through as many past paper questions as you can on variance analysis and thinking about the links between the numbers, because this could come as an essay or a numerical area and is a massive part of paper 2. Okay, good luck.